So traders, I want to do an update video to the video that I did yesterday titled "The Stock Market Will See a Massive Crash When This One Thing Happens." And I want to go into a little bit more detail that I didn't do yesterday. I'll see some questions and so on and so forth. So I want to go into a lot more detail with that in this video today to really explain why this is different to 2008. What is the differences from the next major crash that's coming? And we are going to see a major crash coming. What we saw this year is not the crash, but the differences between what's happening right now and what's really happening on this crisis. What is this crisis and what's going to cause it to trickle down into, into the crash that we're going to see. So let's get straight into it. Don't place a trade based on what you'll see in this video because there is no guarantees of making a profit in the market. It takes you a long time to become a good trader. So this video here is just to educate you to become a much better trader. Alrighty traders, so one thing I want to talk about is really important is the differences between right now of what the crisis that's happening right now just underneath our feet and the crisis in 2008. You cannot compare the both. So you can't, if the cause is different, the effect is different. If the cause in 2008 was the banking collapse, and that was the issue because it was slowly coming to an end. As you go through all 2006, 2007, the banks were slowly getting squeezed and then suddenly, bang, something happened. Well, it didn't just suddenly, bang, happen, right? It was 2008. The whole of, if you go and look at actually the whole 2008 actual, let's go to say a 6 day over here. If we go and have a look at the 2008 period, let's actually go to say an 8 day period here. All right, if we go have a look at the 2008 period, I want you to realize something. If we're going to call this a crash, just know for what it really is. It's just a downward market, right? It's just a bear market. But we did see a severe pullback. So one, if you're trying to time the next big crash, please don't think that the next big crash is one day you're going to wake up and you're going to see this. You have a 0.00001% chance of that actually happening. Okay, and now with all the liquidity in the markets and circuit breakers and so on and so forth, we're not going to see that, right? There's just no way. And by the way, that is a massive pullback, and that was the 2008 collapse because the banking crisis and all the people, basically banks got really greedy and started lending money out to people that just did whatever they wanted to do, right? So that's what was happening in 2008. Fast forward to today, and what's been happening ever since is that now we are going into a currency crisis. We are going into a debt crisis. And see, a lot of people have been saying, but John, the debt's going to explode. And when the debt explodes, it's all over, and we're just going to see a sharp pullback in the markets. And that's it. It's all over. The market's going to crash, and that's what's going to happen. Hang on a minute. Whoa. Slow down. You're partially right there, but partially wrong. So you're partially right because yes, it is a debt bubble. And yes, the debt has continued to get bigger and bigger as the times go on, right? We know in 2008, 2009, they came out and they started jacking up the printing press to support the markets. They had to inject all this capital into banks, inject the capital into the markets, inject the capital into supporting the housing market as well too. And we know what actually happened with that, right? They actually came down and we started to see a 10-year, now possibly even 11-year bull market, big bull market, which we may have a lot more upside to come, by the way, right? A lot more upside to come. But the thing is that obviously the title of this video is the stock market will see a massive crash. The update to what I said yesterday was obviously this video here. And so if we have a look at what is going on right now and the crisis that we're in right now, it is a government debt crisis. That means as the years go on, as long as interest rates stay low, they are going to, because the serviceability is so low on that, they're going to keep jacking up the printing press, which is going to devalue the dollar. But they're going to keep jacking up the printing press to keep putting more money into the system and into what's going on in the economy, right? And so yes, the government has exploded, or the government debt has exploded. Yes, they're printing more money. Yes, it's gone, but it's not going to come an end straight away. It's going to be more of a slow squeeze. Now, why is that? Well, right now, if put it this way, they know when they're getting towards the end, right? So right now they can keep jacking up and keep printing them as much money as they want to, as long as they can service it, as long as they can have the serviceability there, right? They jack it up, they monetize the debt, and then they go do their thing, right? So, but right now interest rates are so low, in negative cases sometimes, that it's just like it's just they can service that debt to where we are right now. I'm not sure why we're looking at. Let's just bring up data chart. Anyway, so they can service that debt. And so because they can service that debt, and because they can keep jacking the printing press, they can just keep putting money and liquidity into the markets, right? Currency into the system. And they're probably going to do that. There's probably going to be another big stimulus passed, and there's going to be more money injected into the economy, which is going to buoy the stock market again even more. Overall, yes, we're going to see our pullbacks. We're going to see our pullbacks in the markets. That's what happens. Okay, not topping action. I don't believe we're in the topping action here. So, and they're going to keep printing it, right? But there will come a time, especially right now, there will come a time where there will come a time where the savers, and if you look at the saving, right, savers have done this, meaning the spikes in saving has gone up like 15 to 20% more than ever before, right? And so now they are spiking in savings, and the government obviously keeps printing and printing and printing and printing more. There's going to come a point in time where these savers start to spend a lot of money, and the velocity of money, basically how many times it's changing hands and so on and so forth, the velocity of money is going to pick up. And within that, and with all this currency in the system, the government's buying all this bad debt and buying everything they can, the property market is likely to go through a massive boom, and also the stock market. That's also called inflation, right? There's a big inflation that's happening with the stock market. So the government will continue to do this until things become so overheated. And not only that, but now there's so much currency in the system that they're buying so much stuff that the supply or the demand outweighs the supply. And guess what happens? Just like toilet paper, right? What happened there with toilet paper? They actually started jacking the price of toilet paper because there was so many people with that. There's so many people buying on this sort of stuff. And then inflation is likely to pick back up. And so it's not until we see this debt, right? This here is the debt. And it's getting bigger, and we're 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 getting bigger, right? The debt's getting bigger and bigger and bigger and bigger. But they can service that debt. Why? Because if I do a little bit of a other trend line, let's go a red, right? The interest rates have been doing what? Say this is over a 20-year period. The interest rates overall have been doing this. Makes sense? So now we're down here. But when there comes a point in time, and people say it just doesn't happen, guys, there will come a point in time over the next couple of decades, and I just say that, where we start to see a spike in interest rates again. Interest rates are going to start to skyrocket again. It will come in time, right? Everything goes in cycles, guys. And if you're thinking what is right now is going to be for the rest of your life, no. Come on, seriously. No. It's not going to happen. Because especially when they start to see inflation pick up, that's going to force these interest rates to start to pick back up again. And when that happens, it's going to be dangerous. How do I know? Because if you look at the recent interest rates, right, the recent interest rates over the last 2 or 3 years, they only can get to about 2 to maybe 3%. Somewhere around there, I think it was at 2.5% maybe. Before what? Before even that became an issue. And guess what happened to the stock market? Guess what happened to the property market? Guess what? Started putting a pressure on the markets, didn't it? Stock market came off, which was around about here. Let's go to the weekly charts so I can show you. So it was actually right here. All right, so let's go to over here. Right, so this is the stock market actually from the high to the low, that came down about 20%. Right, we actually started seeing a bit of a sell-off here, and that's when they started putting on the brakes. But it was this point here that they started to, over here, 2016, 17, 18, they kept raising interest rates, and they got to a point in time where it was just too much, and then that happened, and then they took back, a whole lot of programs and so on and so forth. And obviously now you can see now they're going into rate cuts, right? Rate cuts and so much more. Not only were they dropping the rates, but now they're actually adding stimulus again, and so on and so forth. So the whole purpose here, guys, is for you to understand that I believe, yes, if Biden gets in and he starts to increase taxes, that's going to put a dampening on the market. I believe that'll cause the market to pull back some. Only because it's the opposite effect. Trump cuts rates, bullish for the markets. Biden increases taxes. Trump decreases taxes, stock market goes up. Biden comes in, increases taxes. Did I just say that right? Trump decreases taxes, Biden increases taxes. It's going to do the opposite effect, right? We're probably going to see a pullback just based on Biden there. But if all else fails, when you start to see the interest rates start to pick back up, and it may not be until 2022, 2023, that when you start to see that, you know we're getting towards the end, and you know not only that, but there's going to be a slow squeeze because remember, it's government. So government-assisted jobs, hospitals, firemen, police officers. Like you think that won't happen? Like look what happened to New York back in the 80s, right? I was watching something recently with Donald Trump, and it was like back in the 80s, there was a point there where New York was just going out of fashion or going out of business basically, and thousands and thousands of police officers were getting let go. That can happen again because of the amount of debt. So when we start to see these interest rates, guys, it's going to be it's not going to be like one interest rate rise and it's all over. No, right? If you have a look at the actual stock market, when did we start to raise interest rates? We did our first interest rate. First interest rate was 2016, right? 2016, 2017, around about there. That was the first interest rate rise, the 0.25, right? First interest rate. But as you can see, as time went on, it wasn't until maybe 1, maybe 2 years later that we started to get very, 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 very top heavy through here. And as you know, when this sort of stuff happened, government came in, assisted, stimulus packages, dropped interest rates, and so on and so forth. So please remember, guys, and I'm doing this video because some of you guys really don't see the reason why this is a different crisis. But I hope in this video, the whole nutshell is that this is a massive government debt crisis, and it's going to be a slow, gradual squeeze on the government, not a big bang like 2008. And so therefore, it's going to take time. Yes, they can keep printing more money, but as they start the interest rates and it starts to put a squeeze on the debt and so on and so forth, that's when it's going to happen. So in all fairness, we still could see, with the printing of money they're going to do, we still could see another couple of year bull market out of the stock market. Now, I don't know if that's true or not, but just by looking at what I'm seeing here, that's what I'm seeing. But please don't think that the government is, you're going to read a book or read some articles, watch a video and think that that's it. The government's going to explode. The debt's going to explode tonight. It's going to explode tonight. Oh my goodness. It can't keep going up. Yes, it can. It can, and they can keep printing more money until they just obliterate the whole US dollar. But we'll see about that. So please, guys, don't be... I see some people trying to short this market right now thinking they're going to pick the top. And it's just the wrong thing to do, because with all this stimulus and 0% interest rates, guess what? So there's hundreds of billions of dollars right now in the stock market and chasing the stock market for some sort of return. They can't get it, they can't get it in a savings and anywhere else. Like, it's very, very low. That's why property, because they're parking their money. And that's where also the stock market is now going. Why? Because there's really wealthy people out there are chasing some sort of return. Even a dividend payment, so on and so forth. A dividend payment of 3% is better than 0.4% that they're getting in the bank. Or maybe 1% they're going to get from the bond market. And so that's the reason why you're probably likely to see a lot more upside initially. But when you start to see this thing, guys, when you start to see the interest rates rise, right? That especially if inflation starts to kick back in as well too, and that forces them to start to put interest rates up to try to put a bit of a dampening on what's going on. And especially if it's an asset bubble, meaning property and also stocks, which that could actually form out of this. We could form a massive bubble, stock market bubble, out of what's going on here. And then when they start to raise interest rates, it just goes boom, right? That's when you start to see a sharp pullback. But not until we've actually started to see probably a good couple of months of a big run to the upside, until we start to see some sort of sharp pullbacks from there. So much stimulus is in this market for a big popped up. Don't be short in the market right now, guys. Yes, we're going to get our pullbacks, our 5, 10%, 15% pullbacks in the market. We're going to get that. But there's so much pumped up demand to chase a return right now. Interest rates are zero. When they start to do that, that's when you need to be worried about the debt and what's likely to come. Hey traders, John Howell here. Thanks for watching my video. For a limited time only, I am giving away free access to my brand new trading course. I've put all my most powerful systems, strategies, and trading techniques that I've learned over the last 15 years and put it in this course, and I'm giving it away for free for a limited time. See, in this brand new Go to the Markets by the Balls trading course, and you can get it when you go to johnsfreegift.com, you're going to learn, firstly, you're going to get access to a brand new training that goes for 90 minutes, and you're going to learn all the details step by step to my #1 trading system with over a 90% success rate that works on any market and any time frame. You're also going to learn 3 powerful chart reading and trading techniques. You're also going to learn 2 more powerful trading systems, and also you're going to learn 7-figure trading secrets, mindset techniques, and so much more. There's top 13 mistakes you're going to learn, the 10K per month formula, and so much more. No, this is not a get rich quick scheme, but if you are struggling with your trading right now and you need help, then for a limited time, you can get free access to this. So go to johnsfreegift.com right now, or click on the very first thing in the description, because for a limited time, I'm giving away. So go to johnsfreegift.com right now and start getting access to this full complete trading course, plus also the free training with my #1 trading system with over 90% success rate. Go do that right now, and I'll see you on the next page.